Hello. Yeah. Okay. Perfect. Thank you. All right. So I think, as you can all see, it's a big panel, so we won't waste much time, and we'll get straight into the questions. So, I think as we had discussed, I think the theme for this panel is whether private credit is becoming from niche to the norm. Essentially saying that, we become mainstream, everybody knows about it, almost sort of getting to maturity stage, right? So I think the first question there is, how do you measure something like that, right? I think one of the data points that we have is that private credit is still just, 1% of the overall credit AUM in the market. Also, I think there are a lot of other data points that basically say that maybe it may be too early to say that. So what are your thoughts? What metrics would you guys use? How would you judge something like this? So Rahul, if I can start with you on this one.
Sure. Thank you very much. I think you're right. The data does tell us some of the story. The 1% number is not inspiring as a standalone number. But I think, you also made a point that this industry is about a $10 billion industry a year now. As a sub-asset class, if I think about venture debt, when we began our first fund 10 years ago, it was probably a few hundred crores deployed in venture debt. As of last year, that number is close to $1 billion a year. So I think it's important to look at where we've come from. And then, of course, the benefit of compounding from here on, because the base is that much larger. So I'd say we've come a long way in the last 10 years. Obviously, a lot more work to be done. The demand side in India is very large. I think we have no shortage of demand. I think the challenge historically for all of us has been organizing the supply of capital. And of course, that comes with educating LPs and various pools of capital. And I think that's the journey that many of us are on, is to build that track record and give people the confidence that doing private credit in India provides for meaningful diversification. There's a meaningful return profile. The last 3-4 years have not been easy from attracting global capital, just given how interest rates in the US have been so attractive. So I think one of the challenges as it relates to mainstreaming this asset class is that we are benchmarked to global returns. And the India risk premium plus the currency impact has led to significant headwinds from raising capital perspective.
Ruben, if I may request you to chime in as well on this one.
Sure. Thank you, Bharat. Thank you, IVCA, for the opportunity. So I'll give a slightly longer and a nuanced answer to this, because in some sense, I think this is the crux of today's panel. So currently, I don't think we are at all norm. We are clearly niche. If you look at wholesale lending exposure of banks and say total corporate debt exposure, private credit right now would be about 1.3, 1.4% of the total bank and corporate debt exposure. So clearly we are very small, we are niche. If you compare that to say US, where it's much more mainstream, US currently the private credit would be about 11 to 12% of the total bank debt plus corporate debt exposure, total wholesale bank debt. Couple differences. US private credit is born out of banks lessening risk appetite and banks need to provide risk weights from a regulatory capital perspective. In India, it's very different. In India, private credit exists mainly because of the legal and structuring restrictions on the banking system. So that way, we are quite different from why the industry exists in India. In the US, private credit funds actually compete with syndicated bank loans. They also compete with public bond market. In India, there is no way private credit funds can compete with banks. We operate on the sidelines. In fact, we rely on banks a lot from an exit perspective. So at NEO, for example, a few of our deals have been taken out from the banking system. So that's a key difference. Now, a question about how we can get mainstream. So currently, we are about $10–12 billion a year kind of annual deployment in private credit. I think naturally we'll get to about 20 billion in a short time just by the sheer pace of the market. But if we have to get to say a 50 billion or a $100 billion, what needs to be done? Maybe we can discuss that as we go on in this panel.
Srijit?
Thank you, Bharat, for inviting me and IBCA for giving me the opportunity. So as we spoke, we are right now 1% of the total lending that happens in India, which is very, very far from where we should be. Because as our GDP grows, the requirement for private credit and capex from the MSME segment and the SME segment is going to grow very fast. But there are two-prong issues that we face, in this discussion. The first prong is the fundraising side, where the expectations of an investor is quite high, and the reason is the taxation is quite high on the returns that we generate on the fund. And the second part is the appetite for this high-cost capital from the industry. To give you a small example, let's say today the taxation on the net return on a private credit fund is marginal rate of taxation, which is northwards of 30%. If this taxation comes down significantly, I think that's where the interest from investors goes up and the cost of capital to these SMEs and MSMEs goes up. And that's the way in which we can grow from a 1% to a 7% or a 10%, or probably try and match the US in terms of, the validity or the importance of the performing credit space. So that's primarily the points I would like to raise. So we are a bit far from the norm, but I think we are on the way towards being the norm.
Perfect. Thank you, Srijit. So I think that was on the overall private credit market. But if you look at, see the overall scheduled commercial bank outstanding credit to industry and services, real estate put together is about $1 trillion. Of this, real estate is only $62 billion, right? So about 6%. Whereas in the private credit industry, that number is about 35 to 40%. So which basically means the rest of the industry is not as well covered or is still not aware, or, I mean, is the need not big enough? There is a significant amount of room to grow. So what is holding it back? I think that's the point. So Anant, request you to chip into that, please.
I think on the private credit, so where exactly private credit has a role, where sort of the product is not very, very templatized, you have to dig deeper, you have to take certain calls. Now, real estate as a sector, leave aside the few large developers. For each project, there's a call to be taken with respect to the location, with respect to the sales velocity, with respect to whether the price point is good enough for it to be sold, or there could be calls with respect to approvals. Taking that into account, if you see last 15 years, real estate was actually served by private credit by the large specialized NBFCs. It's just that the vehicles have changed. When they stopped, it got picked up by the large funds. So it was always really ahead. And the second fact is that it is inherently capital intensive in nature. Now what has happened in the other sectors, the use cases which are very, very differentiated, which could in each of the sectors, they have been established. The promoters, businesses, they have tasted success. A lot of the promoters they were very, very hesitant in terms of, they thought that if I'm taking a slightly higher cost debt, what is it that, am I stressed? But what we have seen is a lot of businesses, promoters have created disproportionate amount of value because they were okay to pay a 15-16% kind of return for 2.5 years. See, in a way, in a journey of a company, you dilute your equity once, twice or thrice, and then you discount it for perpetuity. The private credit is a solution capital that comes for 2 to 3 years. So I think that is why we are seeing a lot of repeat deals from the client groups where we have already done these, and the time of solutioning is getting actually lower.
Srijit?
When we talk about a real estate project, when we talk about capex in the real estate space, you have a new project launch, you take credit, you finish the project, you're out of it. When we talk about the industry, the capex is a significant part of your expansion plan, but there is also OPEX which comes along with it. you need to see a very long runway of growth. That's when you go in for that capex. And that's the differential between a real estate developer trying to take private credit vis-a-vis a industry trying to take private credit. So the differentiation is primarily in terms of the longevity of the requirement of the loan. And secondly, the most important part is that when we talk about industry, the expectation of interest has to mellow down a lot from our side. But for that to happen, again, we have to go back to what is the expected return from the investors who come in, or what the investors see. So with a higher rate of interest of 16 to 18%, it becomes a bit challenging for the industry to grow, because that's essentially eating up into their margins. So that's why it becomes a bit of a challenge, when we talk about growth in private credit, especially on the industry side.
Yeah, thank you, Srijit. Karthik, if I may just request you as well.
Yeah, I might have some nuanced answers relative to the rest of my panel on pretty much everything they've said so far. First of all, I'm very glad to notice the crowd. Usually for a private credit panel, it is less than half of today. But there are some benefits of going pretty much towards the end of a 2-day session. So I had a chance to go through all the materials that were kept in the corridor on the right. And a little bit of, Bharat, if you don't mind indulging me, your first question as well on niche to norm. There's a Prequin report which I heard Gitanjali speaking about a few hours ago, where she compared returns across strategies. And private credit and private equity, private equity has been the substantial part of the last 2 days, have been the same in the last 2013 to 2022 decade. So it's very much, and in terms of quantums of money raised, almost equivalent, if not private credit raising more money. So I think definitely as an asset class here to stay in India, definitely showing signs of becoming norm. But I agree with my co-panelists that, it is still in its early stage. But if you look at this, it went from nothing as a Cat 2 industry to $120 odd billion, right? So an industry has been created almost overnight, where a substantial piece of that is actually credit and its various forms. So now, to your question of real estate dominating the credit space, in Sundaram, we just closed our 4th real estate fund. We've deployed 3,500 crores, 65 transactions, consistently done 18 to 20%, no defaults. So I think the industry is capable of delivering those kind of returns, as are other sectors. We run a special credit opportunities fund as well. But just to step back a bit, private credit as an industry operates because of 2 reasons. One, there's a regulatory arbitrage, as Anant and others pointed out, where banks who are the largest capital provider and the lowest cost capital provider can't really compete in a few spaces due to regulatory restrictions. That's really the emergence of the space and the opportunity for us to lend at premiums. The second is a commercial arbitrage, where a lot of the corporate credit funds, and Ruben and I have discussed many, many transactions, really compete. So that is really a function of efficiency, which means turnaround time, providing the right capital for the right sort of situation, solution, as my colleague said, being able to look at flexible structures, allowing end-use flexibility to be able to suit companies that are growing, that are performing, not able to access equity markets, not able to access bank loans because they're too early in their journey or whatever it may be. So those are the real 2 spaces that private credit funds really fill. And within that, yes, real estate is predominant because, at the end of the day, it is a hard, tangible asset where you're able to put a loan to value against everything that you do. But there are times when there are a lot of, real estate transactions that get positioned in corporate credit funds as well. And the reason for that is because there is a tendency in India to be a little more asset collateral rather than do the hard work around businesses and cash flows and so on. But at the end of the day, this panel is represented by numerous strategies across venture, real estate, corporate credit, to some extent, I think Ruben's firm does stressed as well. So, and impact with Avishkar. So I think the common denominator is an ability to access interesting transactions that can't be funded by banks, to be able to structure around them, to have financial covenants that give you an investment grade kind of quality, and be able to charge a risk-adjusted return out of it. I think a lot of the strategies that will evolve, which is why perhaps parts of the industry are still niche and real estate perhaps might be moving towards norm, exist today. So I think that's still a long way to go, considering the demand for capital is in excess of $20 billion a year.
Thank you, Karthik. And thank you for touching on the word impact. And I think, Monu, sorry to keep you waiting for that long. Please, just share your point of view on ESG-focused investing in private credit.
ESG-focused private credit in India is very much a niche niche than regular private credit is. And but it's just heartening to note that over the last decade or so, significant amounts of money have gone into sustainable finance at about $700 billion. Although all led by equity, private credit has been a small fraction of this at $50 billion or so. India, the story is very much same. There are very few funds like Avishkar's ESG-led credit fund, which are doing performing credit, giving loans to SMEs and which are in the sustainable space. I think one of the key reasons why supply of funds has not ventured aggressively into sustainable private credit is because of this belief that if you do private credit in sustainable businesses, you're either compromising on risk or return. I'm just calling it out. But it doesn't have to be like that always. Like for example, at Avishkar, what we do is we use ESG as a strategy to mitigate risks, resulting in delivering returns for the companies as well as the investors. I mean, it may sound like a lot of gyan, but so let me just walk you quickly through an example. One of our investee companies is now India's top exporter of fruits and vegetables. Now, they have integrated social equity into their 5,000 plus farmers and workers that they work with, and adopted environment-friendly practices and made great strides in their business. So, as a result, they have taken a lead in banana exports. It's a humble commodity, but I don't know how many of you know that while India is the largest producer of bananas, our share in exports is minuscule, as under 1%, because of the perishable nature of the product and logistics issues. So they have created historic milestones not just for themselves but for the country, and in the process generated superior returns. They've opened up new markets, they've created premium, they're commanding 30 to 40% premium over their pricing, and reduced costs through reduced wastage. So this is how a true ESG integration creates value. Now, on the demand side, I mean, demand is clearly emerging from sectors like climate and energy transition, green mobility, sustainable agriculture, circular economy. And as these sectors, I mean, these sectors have been fueled by equity so far, but as they mature and provide greater stability to their earnings, they become more attractive for private credit. As also they start looking for non-dilutive capital, which is flexible to fund their next stage of growth. Another interesting aspect that we have seen in our experience is that demand for ESG-led funding is also coming from traditional businesses, which are operating in global supply chains, as they try and align themselves to changing customer preferences globally, to regulatory changes, and the demands coming from the brands that they are servicing. Now, we see that in our own portfolio companies, where we have done companies in auto components, in textiles, traditional sectors like that. So, so I would say, in a nutshell, sustainable private credit, very much a niche, great opportunity. The opportunity set is, for sustainable finance, it's estimated that about $3 to $4 trillion are required every year to meet our net zero goals. And of that, private credit will be 10% to 15%, creating a $500 billion opportunity. Mind-boggling numbers. So opportunity exists, demand exists, and it's time for it to move to the next level of growth. Thanks.
Thank you, Monu. Rahul, I think you guys have been doing some interesting investing in this space as well, right?
Yeah, I'll just build on what Monu said. You know, we're starting to see real appetite from development finance institutions. You know, as a firm, we've been investing for about 10 years now. We would have deployed 6.5 to 7,000 crores across about 200 companies. And when we looked into that data, what we discovered was that at least half that capital had gone into sectors like agri, healthcare, education, transport, all which are deemed to be high impact. And so interestingly, we turned out to be the largest impact fund they'd never heard about. And so I think as we start to, you know, think about, you know, adding new capital relationships, we finally seem to have crossed the threshold into where large DFIs are looking at saying, risk adjusted, to Karthik's point, you know, risk adjusted, the kind of credit that we do offers equity-like returns because many of these sectors will need more balance sheet. You know, the opportunity around EV, kind of the joke is EV is the new fintech because it's going to absorb so much capital, whether it's batteries, charging infrastructure, recycling, OEMs. It's a massive opportunity. And so I think while, you know, on this surface, the hangover of sort of impact and sort of lower return has held people back, what we found is that the returns are equally good. And candidly, from a cycle going forward, there's a tremendous amount of demand available. So I think the tide is turning, and I think a lot of, you know, comes back to us managers being able to articulate to LPs, you know, how our money is going to be put to good use and how you manage risk around it.
Thank you, Rahul. Karthik, quickly from you on the same issue as well. With regards to investing, impact investing and, you know, climate finance and stuff.
Yeah, so, yeah, I agree with Monu and what Rahul said. I think we ourselves, regardless of our strategy, have found ways to try and achieve some level of impact on the ground. For example, our real estate, residential financing, you know, all use IFC's edge proprietary tools to measure GHG emissions, what kind of materials go into construction that will have sustainable impact on emissions, you know, what kind of development plugins can we do to ensure that things like EV charging, recycling, waste management, etc. are incorporated. So, you know, we run impact reports on the same. So we found a way to do this on the corporate credit side as well. So I think ESG, sustainability and impact, you know, certainly are very big hot themes globally, if you look at LPs. In India, perhaps, you know, starting to show some level of traction, but many DFIs, as Monu pointed out before this panel when we were speaking, you know, have a mandate to invest into impact themes in India. So I think, you know, all of us are very, very positive catalysts, you know, who can disintermediate the same.
Thank you, Karthik. And fellow panelists, I think we just need to be mindful of that clock. My heartbeat is going up. Quickly, Monu, so this question to you, I think you had some point of view around blended finance and some innovative structures for this whole ESG space.
Yeah, so blended finance is a unique structure which is a public-private partnership and is you know, emerging as a powerful tool to generate access to wider set of private capital and at lower risks and costs. Let me explain how it works. In blended finance, typically the public capital, which is could be from DFIs, multilateral agencies, or even international foundations in India are providing that. They become catalytic capital through various structures, which could range from straight-off grants to concessional pricing, concessional priced loans, or first loss guarantees or other guarantees or insurance products, or a junior tranche in, you know, in a co-invest structure. So through these structures, what they do is that they provide either a risk buffer layer or pricing advantage, which mitigates the risk-adjusted cost of capital for a private investor to come in. And there is an effective leverage which is created for X amount of capital that the that the public capital comes in. Typically, we see 4 to 5x of private capital which is being generated. And so there is a wider access of capital which comes in to fulfill the target mandates at lower risks and costs. And like in our own fund, we follow a blended finance structure, and it's very effective because the DFIs have come in to fulfill a mandate at concessional pricing or first loss default guarantee kind of structures, basis which private capital finds it easier to come in. In India per se, blended finance has been growing steadily at about 18-19% CAGR, but it's still like it's just touched a $1 billion mark to a couple of years back. That's when the data is. It needs structural support to grow at an optimum level. One of the regulatory changes, in fact, that have just been announced by SEBI in late last year is wherein AIFs are now permitted to have LPs with different economic rights. So this is one of the, in fact, changes which will also help in encouraging blended finance and pulling in more offshore capital or even domestic institutions who are willing to provide that concessional facility. So in fact, we see that blended finance will actually provides not just wider access to corporate capital, but lowers the cost of borrowing for the borrowers through a risk-adjusted lower cost of capital for the private LPs. So, yeah, thank you.
Thank you, Manu. So, Ruben, keeping the focus again on growth, exponential growth, how is India unique from sort of the other markets, especially the West or the Asia Pacific, where private credit is a lot more bigger and a lot more widespread?
Sure, Bharat. So, Bharat, I have been interacting with a few US GPs and also quite a few US and Canadian LPs. The way we are differentiated and also a bit unique is if you look at a typical US GP, leverage levels. So in US, typically private credit funds go up to 6x leverage, and there is a lot of tranching, junior, senior, mezz, etc. India, most typically, we look at 3 to 4x leverage. So you don't find GPs typically exceeding a 4x leverage. And a lot of the deals in India are unitranche. So that's one big difference. In US, private credit is a lot about LBOs, leverage buyouts. In India, because Company Act does not allow free flow of cash flows between, say, OpCo to HoldCo. So most Indian funds lend money quite close to where the cash flows are. So a lot of huge structuring does not happen in a typical Indian private credit setup. Number 3, vis-a-vis US, and this is a feedback that I've got from two large LPs, is the team capability. In US, because investment bankers are a lot more sophisticated, deals are well-baked. In India, it's quite the opposite. There are not too many sophisticated iBankers in the private credit world. Deals are quite half-baked. So the GP capability in India is far more well-rounded, far more balanced, especially around sourcing and especially around diligence. Typical US LP would focus more on structuring and documentation. So that's vis-a-vis the West. If you look at, say, Asian peers, again, Indian market is very well diversified. A typical Indonesian or Australian GP will have a lot more concentration in commodity exposures. Typical, Vietnamese LP will have exposure to maybe the top 25, 30 families because Vietnam is a family-dominated market. Large families control most of the corporate world. But in India, a typical fund would have exposure to at least 8 to 10 sectors. So we are very well diversified compared to some of our Asian peers. So those are some of the differentiation and nuances of Indian private credit market.
Thank you, Ruben. Anand, what can we learn from other markets so that we can grow and become much bigger?
I think 2 things. One is the standardization aspect, which Ruben also touched about. So in general, in the developed market, the structures are very, very clear. It's a senior debt, it's a mezzanine debt, If it's at a holdco, it's a term loan, and people are very, very aware in terms of this is how the document is there. It is very standardized. So you don't end up negotiating. You negotiate, you do a diligence on the business, you take a call, and then you end up signing the deal. I think we spent a lot of time on the ancillary activities, and as a fund manager, right from the origination to structuring, we end up spending a disproportionate amount of time. So I think that is something, some things will actually correct organically. Some things we'll have to put it together as an industry that at least we standardize the documentation related part. So that's one. And the second thing is, of course, as you also mentioned in the launch, the judicial reform. Now, I think the IBC has clearly established the capital structure that is actually ahead of equity. But other than the commodities where it has played out in terms of the recoveries, in all the other sectors, if it gets delayed, the recoveries are abysmally low. So I think, and as compared to, let's say today in UK, if the company goes into default, you can actually appoint an administrator in 3 days and the company can continue to run. And that is very, very important where the sector is not asset heavy. So I think these are the two things which we can learn probably from the developed markets.
Thank you. Rahul, from a venture debt perspective, you want to share some perspective?
Yeah, I just add one more point. So for example, in the US, venture debt instruments are rated and many of them are investment grade. In India, the ratings agencies still don't have a view on rating venture debt paper, and invariably they would categorize it as junk because the underlying assets are loss-making. We've been doing our own rating methodology for 10 years now. We're starting to share it with the ratings agencies. We've seen fairly attractive credit quality. So we hope that over time, these kinds of instruments can also get rated. And that allows for then secondary activity, trading of those positions, which will just deepen the market.
Thank you. Shrijit, I mean, just an open question on drivers, supply of funds. I mean, if we are going to grow and continue to grow at a much faster pace, I mean, what needs to change in terms of, you know, fund availability, capital availability, in terms of the ecosystem? I think that was something that was touched upon.
One of the things which got pointed out was the IBC coming in place. This is going to help us a lot. We moved from SARFACI to IBC. So what IBC does is you want to have a resolution. It talks about 270-day time period to get the resolution worked out. So which is a new thing in the Indian context. And if we move in the right direction, I think we will be in a stage where resolutions could be much faster. What this does is it becomes an enabler for a lot of us to start taking riskier bets. And that helps CapEx in a major manner, especially for an economy like ours, you know, where we are talking about being global leaders on the manufacturing side. Because if CapEx does not happen, there is no way we are going to catch up with a lot of our competitors. Now, what we need to do on the private credit side is, we need to get a lot of our investors habituated to investing in this asset class. Because this asset class is comparatively new. So as they go through various cycles, they experience the returns that get generated through the investment in this asset class. And with a little bit of support from the regulatory side or the tax side, you know, when there's a little bit of decrease on the incidental taxation on the investor, I think there is a probability that this can become a very large play. And this becoming a very large play can enable India becoming a very large play on the manufacturing side. So I think this is one thing that we need to keep in mind. And the final point that I want to make is that we are starting from a very small base. And most of us have top-tier talented people on the fund management side. These are the strongest enablers for investments to get into the performing credit side. And as the deliveries keep happening in terms of returns and closure of funds and generation of return vis-a-vis other asset classes, this category of market neutral investments is going to grow leaps and bounds. And probably 2-3 years down the line, we will be talking about private credit in a completely different tone and a completely different light. So I think the future looks very bright, and I think most of us on the panel will agree with that.
Yeah, okay. Thank you, Shrijit. So IVCA team, I think we started the clock at 35 minutes and not 40, so we have 5 more minutes, yeah? I'll take that leverage. So Monu, quick question. If you're going to grow that fast, where is the money going to come from? Is there sufficient pools of capital available?
Well, technically, there is $400 trillion of wealth in the world. So there is a staggering amount of pool of capital. But there is obviously a huge challenge in channelizing that into private credit. In India, opportunity. Talking of offshore funds, and we deal a lot more with offshore funds, is that getting them to buy in on an India return vis-a-vis where the US is very, very challenging. Because in India, we are talking about the depreciation of the currency, which takes away 3 to 4%. If you are an FPI structure, there's a withholding tax of another 1.5% or so, and and the net return that a US dollar fund will get in India will end up being lower than what they're getting in US, with the US returns, the US interest rates at their peaks right now. So there's a very, very obvious challenge that we face in that supply. Domestically, the HNIs and family offices, of course, have been the shining stars of late. Estimates suggest $1 trillion of wealth with them. They have been coming in, with increased professionalization of their family offices. Now, we see that they have the ability to understand the risks and the nuances of more sophisticated products like private credit, right? So they have come in, but now they're moving to the next step, and they want to go in for a direct co-investment from their own desks, which is another trend which is emerging. While it expands private credit into the companies, into the funds, it's just kind of, it's a co-invest structure. Having said that, from the HNIs and family offices also, now there is an increasing comparison of private credit returns with equities, which over the last 2-3 years were public markets, which were giving great returns. Now, we've seen subdued returns over the last 3-4 months, and we have to see if there is sanity which prevails, because ultimately it's a risk-adjusted return in private credit, which sometimes just gets lost into the overall glamour for getting higher returns. So, yeah, pools of capital exist, but there are challenges in drawing that to private credit.
Thank you, Manu. So I think last 30 seconds for each one of you, starting from you, Anant. Any closing comments you might want to leave?
Yeah, so I think, so today, if you would see that the private credit market in US actually essentially started with institutional, and then the next leg of growth is coming from the family offices. In India, the family offices have taken the lead in the initial part. So I think now what is more important is the liquidity related aspect. So I think what we need to do, and more proactively, is to have more on the secondary side, that whether the units are tradable, whether there are secondary funds who can actually buy out. What also happens is, when it happens, then it evens out the cash flows for a fund, because the exits are going to bunch up. Now, if the secondaries are available, you can give more predictable cash flows to your investors. And the last thing is that as we grow large, possibly it would make sense to have a broader mandate in a single fund, because you can act in the deal cycles, across the business cycles. You can do a performing credit deal, you can do a special situation deal, and you can address the requirements of the client as well. So I think that would be the key, the flexibility that you can establish.
Okay, so I'm going to try to stick to 30 seconds. So bottom line is, I think the opportunity in India is unique. We are in an economy that's growing at 6-7% at a minimum. So doing credit in a growing economy where there is automatic demand gives growth, developmental impact, rescue capital opportunities, that's represented by all of us. If regulation doesn't come in the way and starts putting brakes on the industry, on a do-nothing basis, we've grown from 0 to 120 billion. There's no reason why we can't double in the next few years. From a capital availability point of view, bear in mind, every one of us has raised money with a capital allocation from our investors of less than 20%. 80% automatically assumes that it goes into listed public markets, alphas, and so on and so forth. So we're all competing for 15 to 20% of the capital allocation. If that doubles, then all of our capital pools increase dramatically. And last I checked, capital parked in savings, fixed deposits, GSECs, as of a year ago, was $1.5 trillion by HNIs and retail customers. So all of that is looking for 4 to 5% uplift which is really what this panel provides. So I think great opportunity.
So very quickly, I'll just say one thing is that sustainable private credit needs more awareness and capacity building so that there is greater interest in creating profit with purpose. Thank you.
I think the last couple of years have taught us about the true cost of equity capital. I think there was a time when companies could raise as much money as they wanted at whatever valuations they wanted. That's probably behind us now. So the attractiveness of credit has gone up significantly in the last year. And I think the other thing to note is that all of us have a lot of DPI. You know, it's not just IRR, it's also DPI. So I think that counts in a time like this.
So key question, how do we get to, say, from a $10-12 billion deployment annually to, say, a 50 billion? One, on the demand side, we need to evangelize this asset class a lot more, make mid-market Indian companies, promoters, a lot more aware of private credit as an asset class, number one. Supply side, domestic, we need more participation from insurance companies and from pension funds, hopefully, that will give us deeper and cheaper pools of capital. Foreign money, I think it's just a matter of time with IBC getting deeper and more Indian GPs having, say, longer track records. I think with our risk-reward kind of metric, it's just about time we'll attract a lot more foreign capital. So it's just a matter of time.
The demand seems to be growing, and the reason is as the GDP grows, there is going to be consolidation in shareholding. There is going to be a lot of buyouts happening, and there is going to be a lot of requirement of bridge capitals before IPOs come out, especially in the SME and the MSME segment. This is going to lead to far greater growth of requirement of private credit. On the other side, in terms of fund collection, the experience that most of these investors are going to have, coupled with the quality of teams that most of the private credit players today have, is going to enable the process of fund collection over a period of time. I think a bit of help on the regulatory front, especially the taxation, is going to change the dynamics for all of us significantly. So I think that's something that we just need to keep in mind as we talk about private credit.
Perfect. Thank you.